What are the recent trends in indexed investing? One of the most powerful developments in the financial landscape of the past 20 years is the emergence of indexed or passive investment products as a viable alternative to actively traded funds. Recently, Moody's Investor Services did a report where they estimated that, at least in the United States, as much as 29% of invested capital is now indexed. Morningstar reported that in 2016, over $500 billion has flowed into index funds. At the same time that $340 billion has left actively managed funds. That's a big difference. One of the biggest criticisms against index investing is it tends to make markets less efficient. There's a belief that the efficient allocation of financial capital requires a broad group of bright folks doing securities analysis and actively picking, buying and selling stocks based on their assessments of the quality of the management of these public companies. How have index funds been doing? One of the most obvious trends that we've been able to observe over the past 10 to 15 years is that the performance of active managers has been an unmitigated disaster. Virtually any long-term study that aggregates mutual funds and institutional funds together has demonstrated that they're just not keeping up with their benchmarks. Most recently, Standard & Poor's has measured the performance of actively managed equity funds over the past 10 years. And what they found is that more than 80% have failed to match their benchmarks. Can unconstrained investment professionals like hedge funds make a lot of money in these financial markets that are swamped with indexed investment strategies? The empirical data says no. There's a couple of very good hedge fund indices out there, Barclays Hedge and HFRI. They compile aggregated data on hedge fund performance. Not only have funds of funds, for example, underperformed passive benchmarks of the S&P 500 and the aggregate bond index, but they're having difficulty keeping up with just the rate of inflation. Final thoughts on the matter of indexed investing. I think it's clear that there's a potential problem with the proliferation of index products. Even John Bogle, the founder of the Vanguard funds, he says that financial markets would be chaotic if passive investors basically took over the market. It's just clear from the data that we have to date that we're not there yet. In fact, we're probably not close to being there yet. The US market has been smashing its active competitors. Index investing is still a good way to invest and probably will be for the foreseeable future.